Hello there and welcome to Targets in Focus on the very last day of this trading week. Well, today we are going to have a look at some interesting emerging market currencies. And today I'm joined by Manik Narain, emerging markets analyst at UBS in London, to have a look at the Korean won, the Indian rupee and the Turkish lira. So let's begin with the Korean won. Now, the central bank actually left rates on hold this week. What type of impact did this decision have on this currency?
Yeah, that's right. The BOK left rates unchanged this week, which was a bit of a surprise for markets, which had been expecting a 25 basis point cut. So you've seen a modest increase in yields at the front end since the BOK decision, and a little bit of bounce back in the currency as well. The decision seems to have provided a little bit of expectation that actually the BOK is not necessarily pursuing a much weaker currency, and that's why I think you've seen the currency bounce back somewhat. It comes against the backdrop, though, of Korea being the worst performing FX market in EM this year. The Korean won has sold off about 6% against the dollar so far this year, and the main reason for that really is the rapid depreciation of the Japanese yen, which is a real problem for Korea, given that Japan and Korea compete head for head in sectors like high value-added manufacturing, and so the weak yen effectively comes as a big competitiveness threat to the Korean exporter community. You have also started to see that export growth in Korea has already started to show some signs of disappointment. Korean exports have barely grown in the first quarter this year, relative to where they were last year at this time. So there is some real concern about the impact of the weaker yen. And I suppose the developments in North Korea have hardly helped matters, though I think that's been a peripheral issue for the market so far. We are expecting that in the near term these issues related to the yen will continue to weigh on the KRW. And we don't see much upside prospect for the currency in the near term. So our forecasts for the 1 month are a weakening of the won against the dollar back to about 11.50. Over 6 months, we think, and over 1 year, we think that what hopefully will start to dominate once again is the fact that Korea does have a record high current account surplus. As so far, you've still seen that export growth has been holding up quite well relative to imports. So hopefully that positive current account dynamic will, over time, enable the won to start strengthening again. So our 1 year forecast, our year-end forecast, I should say, for dollar Korea is 1100, so a bit stronger than current levels.
Now, moving our attention to India, we actually saw the rupee rise today as March retail inflation slowed. Now, what are your thoughts today on this and on the rupee's current performance against its US counterpart?
Yeah, I think India is a very interesting and complicated market right now. We're seeing a lot of different trends playing out in the FX market at the moment. On the one hand, there is some positive expectation in the market that the worst of India's trade deficit expansion has already been seen. And so you should see some cyclical reprieve in export growth and the trade balance in the next few months. There's also a bit of expectation that inflation has also passed its peak, so the central bank can possibly cut rates a little further to support growth. So I think in the near term, the rupee it could well be in a bit of a holding pattern around these current levels, 54.50 to 55 against the dollar, as the market digests the slightly better news on exports and inflation. I would stress, though, that we aren't really seeing any evidence of structural reform or structural improvement in the quality of growth, I don't believe, to become fundamentally bullish on the rupee. It's still a currency that I am quite concerned about for the medium term. The reason I am is firstly because we have elections coming up next year, and you're already seeing very clear signs that the government is struggling to withstand the populist pressures that brings. So I think a lot of India's fiscal implementation will be challenged over the remainder of this year as a result of the lead-up to the elections. We may even have early elections later this year and not in 2014 itself. I'm quite worried as well that given that the government is continuing to spend quite freely in subsidizing food and fuels for the rural sector, that we can get trapped in India in a equilibrium of sticky inflation and low growth. And so I think, some of the pressures that we've seen on the equity market recently may actually increase over the coming months, unless we get a very strong rebound in external demand, which manages to pull India through. So look, in the near term, it's possible we are going to sort of oscillate around the current levels due to that slight cyclical improvement. But really, I think the bigger picture for India is that not much has yet changed for the better. You've had a lot of bark and not a lot of bite, unfortunately, from the Indian government so far. And I think that will manifest in a weaker rupee over time. So our 1 month forecasts and our 3 month forecasts are 54.50 and 55 respectively. And then by the end of this year, we're looking for a move towards 57 against the dollar.
Now, Manik, I can't let you go without looking at Turkey today because it is hitting headlines. The governor of the central bank's efforts to weaken the lira are being undermined by stimulus from its counterpart in Japan. Now, investment sentiment has actually been increasing and is becoming more bullish, especially as peace progress is being made with Kurdish militants. Now, what do you think about investor sentiment and how do you see this currency performing?
Yeah, it's true that, sentiment in the markets towards Turkey has been quite positive in recent months. You've seen very, very strong inflows into both bonds and stocks. That's a combination of expectation that Turkey will receive a second upgrade into investment-grade territory this year. They've already been upgraded by Fitch, but the market is now expecting that Moody's will follow suit. And it's also been driven by, I think, an attraction for yield that you mentioned related to the Bank of Japan's recent round of monetary stimulus. I would argue, actually, though, that the central bank in Turkey has been very effective so far in resisting upside pressure on the lira. So while dollar Turkey has strengthened on a 6 month view, actually, the lira against a broad range of currencies has basically been flat year to date. So I think the central bank has been quite smart in the way that it's mopped up some of the appreciation pressure on the currency. You've seen much more appreciation in bonds and stocks rather than the currency, because the central bank has tried to limit the carry appeal of the currency and has been effectively boosting its reserves to weaken the currency as well. So it's actually been quite effective in that regard, therefore. Going forward, I don't think we should be expecting the central bank to change its policy on the currency too soon and start allowing it to strengthen. By contrast, I think they may actually step up their efforts to weaken the currency. And that's because the current account deficit is starting to make a comeback. The central bank is faced with the fact that credit growth is running at close to 25% year on year, which is very strong by emerging market standards at the moment. And it is creating upside pressure on the current account, and Turkey's current account is already the highest in emerging markets at around about 6.5% of GDP. So the central bank doesn't want the lira to appreciate further and risk extending that widening of the deficit even further. I think despite some expectation of Japanese inflows and so on, there is limited appreciation potential for the lira in the near term and over the longer term too. So our 1 month forecasts for dollar Turkey are 180 against the dollar, and then gradually rising to 185 by the end of this year, possibly with risk skewed to the upside if the current account swells quicker than what we're currently forecasting. So I think that the central bank will continue to allow the bond market to decouple from the currency.
Manik, as always, it has been a real pleasure today. Well, viewers, have a great weekend and do remember to tune back in on Monday. But for now, goodbye.